Welcome to the Personal Pension Radio Podcast, where it's all about helping you complete your financial journey to retirement. Discover time-tested strategies and get unconventional insights into wealth building and retirement that actually work. Break away from the herd and go for the retirement you dream of. And now, here's your host, the income engineer, Kraig.
All right, back on Personal Pension Radio. Thank you for joining me. Truly appreciate the support. I appreciate all the feedback. If you like the show, if you've got a comment, a thought, I would love it if you would go to iTunes and leave a review. Not difficult to do, but truly appreciate it. iTunes likes the reviews, just like Facebook and all these other social interweb things. They love those reviews and feedback as far as how they rate and rank these shows. So, if you feel compelled to write a review, please do that. Leave me one of those 5-star reviews if you are so inclined. As you heard in the intro, I am the income engineer. I am broadcasting from my studio workshop here in Southern California. I am actually a woodworker. I love that as a hobby, as my therapy, and my mom's Mother's Day gift is actually right behind me here in the workshop. I made that over the weekend. Very cool little thing, that an idea that just came to me, and I like this kind of stuff, so I built it. Now, the income engineer title. Someone asked me about that. They actually saw it on my business card, and the person that I was meeting with was actually an engineer. So they asked, of course, what type of engineering? Are you really an engineer? Well, truth be told, I am not a classically trained mechanical engineer or civil engineer or anything like that. I chose the title of the income engineer specifically because of the conversation around retirement income planning. And years ago, when I realized that the education that was given to me by the Wall Street financial advisory education machine never really taught me the complete picture of retirement income planning, really left me with half the answers at best. And when I learned how to put together an actual designed income plan, when I really learned that it took more than just an investment portfolio, or more than just a life insurance, or more than just real estate, or more than just annuities, when I realized that all of those things truly had to be designed together, that's engineering. And I love that topic, and I love that idea behind designing a retirement income plan. It truly is engineering. That's where the income engineer title came from. So, quick disclosure, because I am going to jump right into the show today. Quick disclosure, I'm not an attorney. I am not a certified public accountant. I am certifiable as a financial planner professional. Please, as qualified as I might think I sound, please don't act on advice that you hear from financial entertainers on the radio, on podcasts, on TV. Don't act on things that you hear on this show as if you're hearing personalized advice for you. Meet with a qualified financial planner before you actually take action. And I would love that financial planner to be moi, to be the income engineer. I would love to meet with you. I meet with folks all over the country. Through the miracles of technology, the world is a much smaller place nowadays. So if you have a question, if you'd like to take a walk down your information together, we can do that. Send me an email, Kraig@kraigstrom.com. That's Kraig @kraigstrom with an M.com. Let me jump right in. The first segment, watch your step. Last week, I had to bring my favorite financial entertainer back to the show. I got a number of comments from listeners and comments as well from additional posts that ended up on LinkedIn. Please, financial entertainers, I've mentioned it before. Somebody asked me, what's a financial entertainer? Well, a financial entertainer is someone who spews out financial advice and, air quotes, financial wisdom and they're not licensed as a financial planner. They may not even be classically trained even in the basics as a financial planner or a financial advisor. They have no regulatory oversight. Basically, they can say whatever they want under First Amendment, and it doesn't matter if it's right or wrong. It generally doesn't get challenged at all. That's a serious problem, right? Financial entertainers, in many cases, give out good, solid, fundamental, basic financial principles and advice. That's good stuff. But when they start getting into the details and they get into the weeds of complicated questions like the one that I mentioned on the show last week, so if you haven't listened to that, go back and listen to that episode so you can really understand what you should be watching out for and what you should run away from when it comes to listening to these financial entertainers like Dave Ramsey. Now, this week, I've got to bring it to your attention. This is one of my own financial planning magazines, right? Financial Planning Magazine is a publication that comes to the, you guessed it, financial planner community. So I get my Financial Planner magazine, and it's sad because often the Financial Planner magazine is a source for content for me to rant about or put in the Watch Your Step segment of my show. So one of the articles caught my attention, and it referenced and invoked the words maximum income. Like, of course, I'm the income engineer. That's the whole point of this show, is to help you pay attention to maximum lifestyle income someday in retirement, whatever that means for you, right? So this article in Financial Planning Magazine started with a subheading: there are ways a planner can confidently ensure a client will not run out of money. Oh, well, now my eyes, ears, I'm ready. Let's go. Tell me what you got. So this is a 4-page article. Remember, started with the subheading that said, there are ways a planner can confidently ensure a client will not run out of money, but some approaches have more drawbacks than others. Okay, I'm in. Let's go. So remember, this is 4 pages. The article focused solely on investing as the basis for the maximum income conversation. Investments only. Investments meaning things that have risk. Wall Street, right? And I've mentioned this before, but I'll mention it again. Who controls the purse strings, the marketing budget, really, the marketing income for Financial Planning Magazine? Yeah, Wall Street. So who controls the message for Financial Planning Magazine? Yeah, Wall Street. Do you really think that Financial Planning Magazine is going to do anything to significantly upset their primary advertiser? Of course not. It's just not good business. So this doesn't surprise me. It does disappoint me. I'm always hopeful, right? So the entire article focuses on investment, investing as the basis for maximum income, and this idea of variability of income. And there it is, the 4% level income withdrawal, which means that, and this is what they say, which means that if a portfolio goes down, your income goes down. So, sorry, you took a 20% loss in your account value, so now you just keep your 4%, but you take a pretty significant reduction in your income because we're just going to use a 4% income. Or, here's another one, or we're going to use a fixed income rule with a 2% return versus a fixed draw percentage based on the account value. Did you hear that? We're going to use a fixed income investment with a 2% return. Now, this is an analysis done by the author in Financial Planner Magazine about maximum income for a retiree. And they actually say, we're going to do it with a 4% level withdrawal, which means that if your portfolio goes down, your income goes down. That doesn't sound like maximum income. Okay. We're also going to use a secondary comparison in the analysis to say, well, what if we just use a fixed income investment that gets a 2% return? What? Right? I mean, okay, so I'll just do this. The article ends with this. I thought the article was going to say, like the author was going to say it, like he was going to say something. He's going to come in on his white pony, Shetland pony, tiny little thing. He's going to come in on his white pony and save the day and say, here's another option. Now, here's what he says. In summary, retirees who crave certainty may want to consider a fixed, there we go, I was like, oh, here we go, may want to consider a fixed return portfolio combined with a variable withdrawal. What? Oh, so let down. I thought maybe they'd say it, right? And he goes on to say this as he closes up this article. Remember what the whole idea was, maximum income, right? An important point is that the variable annual withdrawal will result in declining withdrawals from the portfolio every year if the fixed return of the portfolio is lower than the withdrawal percentage. What? The whole idea was maximum income, right? I thought they were actually going to say something of substance, not one word about guaranteed annuities. Guaranteed annuities, which pay income differently than investments. The author's own analysis comes out saying that it didn't work. It actually says that in the article, that our own analysis and the scenarios that we use didn't work. You're writing an article about maximum income and you use data that basically says your method is wrong. And it gets into Financial Planning Magazine as an article that financial planners around the country are supposed to consume and bring in for their edification. Are you kidding me? Are you kidding me? Folks, if you're listening to this, congratulations. You're listening to a financial planner who is one of a few, really, relative to the large numbers of financial planners and advisors. I am one of the few that has woken up, and I do not drink the Kool-Aid anymore. I don't. I call BS on this. This is so wrong, right? It is just so wrong. And I'm going to cover the solution that's missing in the article. I'm going to cover that in the next segment. Now, before I forget, I'm going to say it on every episode from now on and forever because people still don't do this. Freeze your credit. Freeze your credit, right? I heard someone call in to another financial entertainer show and say, oh, I'm worried about my identity being stolen and I'm worried about this, that, and the other thing. And the answer was, go get LifeLock. Go get one of those credit monitoring services. Well, those are good. Those are fine. But the best way, the bulletproof way, is freeze your credit. Contact the 3 credit bureaus and for $20 or so, freeze your credit. That's it. No one can use your social security number. No one can get a job with it. No one can buy a car with it. No one could rent an apartment with it. No one could do anything with your social security number because when a merchant wants to run your credit and it's frozen, guess what? The bad guy or bad girl is out of luck. Freeze your credit, people. Come on. Now, segment 2. Listener questions and rants. If you didn't hear it last week, had a great question come in, and I gave my details on collateral lending. Collateral lending is a concept that if you don't understand it, it is a game changer for enhancing the returns on most any investment. Please check out the collateral lending conversation in the last episode. Now, this week, this is where I want to continue from the Watch Your Step segment. Individual risk versus pooled risk. Hear that. Individual risk versus pooled risk. This is what was missing in the financial planning article, right? The Watch Your Steps segment reminded me that a concept I teach all the time with clients, pooled risk versus individual risk, right? When you have an investment-only retirement plan, like the one referenced in Financial Planning Magazine, you are alone in your own risk pool. Who is sharing the risk of the ups and downs of that investment and the outtakes of income? Who's sharing that risk? Just you. You are the only one sharing the risk of running out of income. In a company pension plan, which are rare these days, and in guaranteed insurance company annuities, the insurance company is spreading the risk of income over thousands of people. So now, in an insurance company annuity scenario, how many people are in the risk pool sharing the risk of income? Well, thousands and thousands of people. By pooling the risk of paying out income, the insurance companies can offer something that no investment account can offer. It's called mortality credit. Mortality credit is a phrase you will never hear in an investment-only discussion because mortality credit only exists in the insurance space, in the guaranteed income conversation. The insurance companies know that some people who are receiving income, right? Some of those people will not live as long as the others. The people who don't live as long as the others who are receiving income as well, the people who don't live as long, right? They die earlier. They insure the longevity of everyone else in the pool. The way that mortality credit works is exactly that. The people who don't live as long collecting an income check insure the longevity of those who do live a long time. That is pooled risk. And that is how pension companies, very rare, and how insurance companies can offer much higher income rates than investment company plans where people are alone in their own risk pool. Okay? So hear me on this, folks. The part that was missing from the article on maximum income was there was no discussion of, hey, you could also maybe include this thing called a guaranteed annuity that offers income rates in the 5, 6, 7. I've seen income rates for older people, now it depends on your age, in the 7, 8, 9, 10% income rates. Now, these are annuities. These are very different than investments, but guess what? Annuities are not investments, and therefore you don't hear the investment-only community mention annuities very often. Okay? I suggest people look at their income with a pooled versus individual approach when it comes to risk. And ask yourself this question. How much income would you like to know with certainty is just simply guaranteed to come in, right? If you could have enough guaranteed basic income to cover your needs, to cover your monthly bills, your basic needs, could you leave other retirement assets in investment positions for long-term growth, right? That's just one idea to think of, that if you could have a block of your income that you know without a doubt it's going to come in every month, and that will sustain you, that if you needed to slow down or stop the income from your investment side of your world, that you've got guaranteed income no matter what, how much more confidence would you have in leaving a good chunk of your retirement assets in investment positions for growth, right? So now what's happened here is you've brought certainty to your retirement income. Instead of this conversation in the Financial Planning magazine about 2% fixed income and you've got to have 4% variable income based on the account value and yeah, you might run out of money in 40 years and just drives me nuts when guaranteed annuities. Now, let's be clear. The regulators will say, well, those are only guaranteed by the claims paying abilities of the insurance companies. Yeah, they're guaranteed by the claims paying abilities of the insurance company. But here's a little insider bit that you might want to consider. Nobody in the history of mankind that I can find anywhere, and even talking to national insurance company regulators, no one in the history of mankind has ever not received their income payment from an insurance company annuity. It doesn't exist. There's no statistic for it. If you know of one, please email me, comment, send me a note. Never been able to find any reference to anyone anywhere ever missing an annuity income payment from an insurance company. Could it happen? I suppose zombies could rise up and run across the countryside. Yes. Could it happen? I guess so. What I'm talking about, folks, is simply a piece of income planning knowledge that does not come from Wall Street, rarely comes from investment-only financial advisors. It is this. Just to recap. Consider your retirement income and your cash flow in a guaranteed versus non-guaranteed mindset, a risk pooling versus individual risk mode. How much of your income would you like to know is simply guaranteed? Keep it in mind that way. Think about it. And then you build certainty into your income going forward, and you can readjust over time. Okay, so that's going to wrap it up for today. What I do want to remind you of is check out my LinkedIn. Go to LinkedIn. I have actually started something called the Freeway Series. The Freeway Series is a series of videos from the road in Southern California traffic. Yes, it is a series of indeterminate length. While I enjoy Southern California traffic, I actually talk on topics from the podcast, but also additional topics that are not included in the podcast, short bits about financial topics that you might find helpful. There's actually one there recently about home and car insurance limits, kind of appropriate to be recording that on the road. And for those of you who comment or might be thinking right now, wait a minute, you're recording video while you're driving? Yes, I actually have the camera set up and everything set up before I leave, and I have a Bluetooth button on my steering wheel that I don't actually ever have